Welcome to the Deep Dive. This is where we take your sources, your research, and really boil them down to the key nuggets of knowledge. Think of it as your shortcut to being genuinely well-informed. We try to pack in those aha moments, maybe some surprising facts along the way. Today, we're doing a deep dive into a pretty comprehensive earnings analysis.
That's right, yeah. Today, we're peeling back the layers on Netflix's Q2 2025 earnings report. And our mission, really, is to get past just the headlines. We'll use a structured five-part framework to really understand these results, see them in the context of what the market was expecting in real time. It's about seeing not just the numbers, but, well, what they really mean.
Okay, sounds good. Let's unpack this. So for you, the listener, if you want to grasp complex info quickly, thoroughly, this deep dive should lay out what really drove Netflix's performance recently, and also what management seems to be signaling for the future. You'll get those critical details, hopefully without feeling, totally overwhelmed by data. All right, now for slide 1, the at-a-glance scorecard. So we're kicking things off with the big headline numbers. Netflix reported second quarter results that, well, they actually beat Wall Street's expectations, both top and bottom line. They pulled in $11.08 billion in revenue. That was a beat against the $11.04 billion analysts were expecting. And diluted earnings per share, that came in at $7.19, also a beat compared to the $7.07 estimate. So good numbers on the surface.
Yeah, good numbers, but what's fascinating here is the reaction. While the initial analyst sentiment was, broadly positive, they liked the execution, the strategy, especially ads and content. This optimism was often, let's say, tempered. A lot of analysts noted that, look, this strong performance, it was largely expected, and maybe more importantly, it was already kind of baked into the stock's high valuation.
Right. So the market wasn't totally surprised.
Pretty much. The bar was set high, and they cleared it, but maybe not by enough to really ignite things further, given the price.
Okay, so what does this all mean when we look at the raw growth then? Total revenue grew 15.9% year over year, hit $11.08 billion, up from $9.56 billion. But here's where it gets really interesting, like you were saying. Net income surged 45.5%, from $2.15 billion up to $3.13 billion. And diluted EPS soared even more, 47.3%, jumped from $4.88 to $7.19. And that's a massive divergence. Why did earnings grow so much faster than revenue?
That's the critical question. And the report points to two main things. First, just powerful operating leverage. Netflix's operating margin, that's the slice of revenue left after covering operating costs, it expanded dramatically, rose to 34.1% this quarter. That's a full 7 percentage points higher than the 27.2% last year. So a much, much larger chunk of each revenue dollar is flowing straight to the bottom line as profit.
Okay, so efficiency gains, basically.
Huge efficiency gains. And second, they were actively returning capital to shareholders, share buybacks. They spent $1.6 billion to repurchase 1.5 million of their own shares. Now, if you think of the company's total profit like a pizza, a share buyback reduces the number of people entitled to a slice, right? So each remaining slice gets bigger.
Ah, okay. Fewer shares, same profit, higher earnings per share.
Exactly. The total share count actually fell from about 439.7 million down to 434.9 million. That directly boosts the EPS figure.
Got it. And for those trying to understand the difference, you mentioned diluted EPS.
Yeah.
What's the key difference between basic and diluted EPS? Why focus on diluted?
Right, good question. Diluted EPS is generally seen as the more conservative, maybe more complete figure. Basic EPS just divides net income by the shares currently out there. Diluted EPS, though, it adjusts for all potential shares that could be created, things like stock options, convertible debt, stuff that could dilute existing shareholders later, so it gives you more of a worst-case scenario for shares outstanding, providing a fuller picture of earnings per share.
Okay, that makes sense. Let's move on. Moving to slide 2, the engine of profitability. The report really highlights that this impressive earnings beat wasn't just revenue growth. It was fundamentally driven by Netflix improving its core profitability, specifically that operating margin we just talked about.
Exactly right. The operating margin for Q2 2025 was 34.1%, and that's a substantial jump from 27.2% a year ago. Put it this way, for every $100 in revenue, Netflix kept $34.10 as operating profit this quarter. Last year, it was $27.20. And what's interesting is this result was actually slightly ahead of even the company's own forecast. That suggests really strong cost control, good operational efficiency across the business.
Okay. The report also talks quite a bit about understanding GAAP versus non-GAAP, specifically the impact of foreign exchange, or FX. Why is it important for us, for the listener, to understand this for a global company like Netflix?
Yeah, FX is crucial for global companies. We connect this to the bigger picture. An FX neutral calculation basically strips out the effect of currency swings. You see, for a company earning revenue in dozens of different currencies, shifts in exchange rates can make their reported US dollar results look stronger or weaker, even if the underlying business hasn't changed much in local terms. By showing FX neutral figures, Netflix lets investors see the, let's call it, true operational growth. For example, in Q2, reported revenue grew 15.9%, remember?
Right.
But FX neutral revenue grew 17%. That difference tells us currency movements were actually a slight headwind this quarter, making the reported growth look a bit lower than the underlying operational growth.
Interesting. But looking ahead, they mentioned something about FX becoming a tailwind.
They did. Management noted that most of the increase in their full-year revenue forecast is actually because the US dollar has weakened recently. That now acts as a tailwind, boosting the value of foreign earnings when converted back to dollars. Now, this raises an important question. Is the improved outlook just about currency fluctuations? And crucially, the answer seems to be no. The company also raised its full-year operating margin target to 29.5% before factoring in this new currency tailwind. That signals real confidence in the core business's profit-generating ability, separate from those unpredictable macro currency effects.
Okay, that's a key distinction. Good. Now for slide 3. The engine room business segment performance. So Netflix's overall growth is, a mix of how it's doing in different parts of the world. Let's dive into where they're finding that growth.
Yeah, this regional analysis is quite revealing about their strategies. What we saw this quarter was pretty healthy year-over-year revenue growth everywhere. In fact, every single region posted double-digit increases on an FX-neutral basis. That's strong.
Okay, let's break that down. You can first. U.S. and Canada.
Right, you can. That's their most mature market. Revenue growth there actually accelerated to 15%, which is up quite a bit from 9% in Q1. And management was clear. They attributed this directly to the full quarter impact of price changes. So those price hikes seem to be sticking without losing too many customers.
That's significant for a mature market. What about EMEA? Europe, Middle East, Africa.
EMEA also looks strong. Reported growth was 18%, and even FX neutral, it was a healthy 16%. So robust underlying performance there too.
And LATAM, Latin America.
LATAM. This region gives us the clearest picture of that currency volatility we talked about. Reported revenue growth was only 9%. Seems okay. But FX neutral growth, a powerful 23%. That huge gap really hammers home the significant headwind that the strong US dollar was having on results from Latin America.
Wow. Yeah, that's a big difference. And finally, APAC, Asia Pacific.
APAC was the star in terms of growth rate. Reported revenue up 24% year over year. This just shows continued momentum, highlights the success of their expansion efforts, and points to that really large growth opportunity they still have in those Asian markets.
Okay, so growth across the board, but particularly strong internationally. Now, here's where it gets really interesting for me. The report says this strong international performance isn't just luck. It's a direct result of their content strategy. So what's their secret sauce there? What are they doing right?
Well, if we connect this to the bigger picture, management calls their strategy local for local. What that means is developing shows and films specifically designed to deeply resonate with audiences in their own countries. We see this paying off, right? Hits like Squid Game S3 from Korea, Exterritorial from Germany, The Eternaut from Argentina. By investing in local creative talent, Netflix produces stories that feel authentic to those audiences. And then sometimes, like we saw spectacularly with the original Squid Game, these very local stories tap into something universal and just explode globally. This strategy effectively turns cultural diversity from a challenge into a real competitive advantage, driving engagement and ultimately revenue worldwide.
That's a great way to put it, turning diversity into an advantage. Okay, moving to slide 4. Financial strength and shareholder rewards. So beyond just the quarterly profit numbers, a company's long-term health really depends on its balance sheet, how it manages its money, how it allocates capital. What does Netflix's Q2 report tell us on that front?
What's fascinating here is that the report shows a company with a really solid financial foundation and one that's increasingly focused on, well, rewarding its shareholders. A common metric we look at is the debt-to-equity ratio. Netflix has about $14.45 billion in long-term debt and almost $25 billion, $24.95 billion in stockholders' equity. That gives a pretty conservative ratio of 0.58. It basically indicates their debt load is well managed relative to their equity base. They also ended the quarter with a nice chunk of cash, $8.2 billion on hand.
Healthy balance sheet. And a key element of their financial strategy now is returning that excess cash to shareholders through share repurchases, right? We touched on this earlier.
Absolutely. It's become a major part of the story. During Q2, they repurchased 1.5 million shares, spending $1.6 billion. And like we said, that directly increases earnings per share by shrinking the denominator. Management's commitment seems pretty clear, too. They still have $12.0 billion left under their current share repurchase authorization. That signals, significant capacity for more buybacks in the future.
So what does this all mean for you, the investor? I mean, where is all this cash coming from that allows these big buybacks? It wasn't always like this for Netflix.
No, it definitely wasn't. This really robust capital return program is only possible because the company is now generating powerful free cash flow, FCF. Remember, FCF is the cash a company produces after paying for its investments, its capital expenditures. It's the cash left over that can be used for things like buybacks, dividends, or paying down debt. In Q2 alone, Netflix generated $2.3 billion in free cash flow. That's strong. And as a result, they raised their full year 2025 FCF forecast. They now expect between $8.0 billion and $8.5 billion for the year. This whole evolution, from a company that used to burn cash rapidly to fuel growth to becoming this cash-generating powerhouse, that's fundamental to the whole investment thesis today. It's a huge shift.
Yeah, a real transformation in the business model. Okay, finally, we're moving to slide 5, the road ahead management's outlook and key takeaways. Let's try to synthesize the quarter's performance with what management is saying about the future. What's their outlook say for Q3 and the rest of the year?
Okay, so for Q3 2025, the immediate next quarter, Netflix expects revenue to grow 17% year over year. That's both on a reported basis and FX neutral, so they expect currency impact to be minimal next quarter. They're also projecting an operating margin of 31% for Q3. That would be another nice step up, a 2 percentage point improvement year over year.
And for the full year?
Yeah, connecting this to the bigger picture for the full year 2025, management signaled pretty strong confidence by raising guidance across the board. The revenue forecast got bumped up to between $44.8 billion and $45.2 billion. That now represents 15% to 16% annual growth. The operating margin target was increased to roughly 30%. And that free cash flow forecast we just mentioned also got increased to that $8.0 billion to $8.5 billion range. So positive revisions all around.
Okay, so we covered a lot of ground. What does all of this tell us? If you had to boil it down, what are the biggest takeaways from this deep dive for our listener?
That raises an important question, summarizing it all. I think here are the key takeaways. First, powerful profit engine exceeds expectations. It really was a strong beat and raise quarter. We saw EPS grow nearly 3 times faster than revenue. That was driven by that massive expansion in operating margin, hitting 34.1%, powered by things like pricing power and the growing ad tier.
Okay, profitability is key.
Definitely. Second, global growth strategy is firing on all cylinders. Growth was really broad-based. All regions showed double-digit FX neutral growth. And that local for local content strategy, it seems to be a genuine competitive advantage now.
Makes sense. International is working.
Third, confident outlook boosted by FX tailwinds, but with a caveat. Management raised guidance everywhere, signaling strong momentum, which is great. However, it's really important for listeners to note that a significant chunk of that revenue guidance increase is actually due to favorable currency moves, that weaker U.S. dollar. And currency moves are, notoriously hard to predict. They're a macroeconomic factor, not purely operational success.
Right, so some of the lift isn't from the core business itself.
Some of it, yes. And finally, fourth takeaway, the valuation paradox. While the operational results were excellent, really strong, the report itself and analyst commentary highlights that this performance was largely expected. It was sort of priced into the stock already. Netflix trades at a premium valuation, and that means the bar for future performance remains exceptionally high. It's a paradox because they're executing well, but the market demands near perfection at these levels.
Yeah, that's a great summary. This deep dive really paints a clear picture, doesn't it? Netflix is transitioning into this new era, focused on profitable growth. Those strategic pivots, the ad tier, cracking down on password sharing, using their pricing power for music. They aren't just ideas anymore. They're clearly driving the bottom line now. And that financial strength is fueling those big buybacks, plus continued investment in that global content machine we talked about. So while yes, the market's high expectations and that premium valuation are definite challenges, the underlying operational momentum seems strong. And the confident outlook from management tells a story of a business that's really solidified its leadership. They've built a powerful, profitable engine for the years ahead. And hopefully for you, the listener, going through an earnings release with a consistent framework like we did today helps you move beyond just the headlines. It's hopefully a repeatable method you can use to build a deeper understanding of your investments over time. Just a quick note before we wrap up. This report is for informational purposes only. It does not constitute financial, investment, legal, or tax advice.
All investment decisions should always be made based on your own research and in consultation with a qualified financial professional. While we've made efforts to ensure accuracy, no guarantee is provided. Also, please be aware this report was generated by an artificial intelligence model. While it's designed to adhere to strict data sourcing, errors or omissions may still occur. All information should be independently verified by you before making any decisions based on it. Like and subscribe to stockanalytics.ai, YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.